Hello students, welcome to Prudential Business. So students, in our previous video, that is in Financial Management Part 1, we had discussed in brief about the various concepts that we will be learning in the chapter Financial Management, right? I hope whatever we'll study in the chapter Financial Management, that is crystal clear to all of you. We have discussed in brief. However, we'll be discussing in details in the slides to come. And in our previous video, we have also discussed about the meaning of the word finance, meaning of the word funds, and the concept of financial management, right? Funds and money is almost the same, but that is not similar to that of finance. Finance is the amount of money that a particular business requires, okay, or from where it is going to acquire that amount of money or funds, okay, and how well it is going to utilize it. So the amount of money that will be used in the regular course of activity of business, that will be called as finance. And managing that activity, just how are you going to manage it, like from where are you going to acquire it, how well are you going to utilize in your own business, and how well are you going to distribute the amount of funds to all the stakeholders, or how well are you going to return the amount of funds. All those things will be called as management of activities. Management of what activity? Management of finance, or in short we will be calling it as financial management, right? I hope we have all these things we have discussed in our previous slides. I hope it is clear to you. So now in this slide we will be proceeding further. Okay, so here in this slide we will be discussing about the various activities or the role where the financial management plays its part. Okay, so in the first case, the financial management will be required in determining how much fixed assets a particular firm needs to have. Okay, whether fixed assets can be your land, machineries, buildings, purchasing of your own any types of expenditure that will, which will be for the lifetime of the business or for a extended period of time. Whenever we say it is an extended period of time, it must be more than 1 year. Okay, so those types of activities or those types of investment, how are we going to have those amount of funds? So take for example, we want to have a particular building or we want to have a particular machinery. So what will be the total income from that machinery? What will be the total amount of interest that, or what will be the rate of return from that machine? All those things as we need to discuss beforehand. So for that particular purpose, financial management will be required. Next, you see, in determining the amount and composition of current assets. Current assets can be your your stock, cash in hand, your stocks, bills receivable, payments, sundry debtors, sundry creditors, all those things is in regarding to management of all those activities. Take for example your sundry creditors. How much period of credit do you want from them? The amount of credit period you want from the creditors will depend upon the amount of credit period that you give to your debtors. So all those activities, to determine all those activities, we need to have we need to deploy financial management. Okay, next you see the amount of short and long term funds. Now in our previous classes we have learned about the methods of or the sources of short and long term funds. In class 11 also we have learned it, what can be your short term funds and what can be your long term funds. Like taking a loan from a bank can be your long term funds, but for example your public deposits, trade credits, all those things as comes under the purview of your borrowed funds. All those things as will be required for shorter amount of time. Now you see, the firm which has a policy of liquidation prefers to have more long-term finance, although with that the profits will decrease with the payment of longer interest, but will have a privilege to pay lesser amount of interest. Now you see, what does this statement tells us regarding the amount and the amount of short and long-term funds. This policy depends upon the liquidation process of the firm, or the firm which prefers to have a policy of liquidation. Liquidation, that means a firm, if it has the objectives of maintaining a large number of liquid cash or cash in at their current assets, in that case, if a firm wants to have large amount of cash with their hands, then they will prefer long term finance. Okay, this is just an example why the long term funds will be required by a particular firm. And if a firm prefers to have long-term funds, then their profits will no doubt decrease, but one privilege is that they will have they need to pay a lesser amount of interest. Take for example, if you have taken a loan of rupees 1 lakhs from a particular period of time, and if you want to repay that amount of loan of rupees 1 lakhs within 10 months, then you need to pay 10,000 each, right? Now if you prefer to repay that amount of rupees 1 lakhs by paying rupees 5,000 per month, then you will be having a longer period of time, that is for 20 months. After 20 months only you will be able to repay back the amount of the loan of rupees 1 lakh that you have taken it by paying rupees 5,000 each in every month. So now you see, if a firm wants to have a policy of liquidation, that means if they want to have more and more liquid amount of cash or cash in their hand, then they can repay the amount of whatever loans they have taken after a longer period of time, and this will however decrease their profits, no doubt, but they will have a privilege, or they will be have an advantage of paying lesser amount of interest but for a longer period of time. Okay, so why their profits will decrease? Because for a larger period of time they need to repay whatever amount of loans they have taken it. Okay, I hope this is clear to you. Next, you see, these are the other areas in which financial management will be required. Okay, number one, here you see long-term finance. If a firm wants to have long-term finance, then they can go for issuing of equity shares. I hope equity shares is clear to you. In in class 11 we have discussed a lot about equity shares, then bank taking a loan from a bank, then global depository receipts or American depository. These are some of the examples of long-term finance. Usually whenever we talk about long-term finance, bank loan or taking a loan from any financial institution usually constitutes of long-term finance. Okay. Next you see short-term finance. This, in the cases with short-term finance also financial management will be required. Okay, so like your trade credits. Trade credits refers to the amount of loan that one trader will be taking a loan from another trader. However, this is for a shorter period of time. Next is a bills discounting or discounting of bills. Whoever used to sign a bill of exchange, in the middle of that, if he wants to have the amount of money, then they can go for a bank and they can discount the bill. That means they can encash the amount of bill. Okay, that is called bill discounting. Next, commercial papers and certificates of deposits. These are issued by large credit verdict companies. Okay, so that can be your short-term finance. Now you see, the firm must strike a balance between the financing decision, both the short-term and long-term finance. Now if a firm wants a particular amount of funds for a particular amount of period of time, then it should decide well in advance whether they can go for taking a loan from a bank, or they can get that amount of money by issuing of any short-term financing instruments like your commercial papers or certificate of deposits. Okay, I hope this is clear to you. Next you see point number 4, breakup of long-term finance into debt and equity. Usually for long-term finance, if a firm wants to have long-term finance, then they should analyze well in advance whether they should go for equity or whether they should go for debt. Usually whenever we say it is an equity, we refer to issuing of equity shares. Those equity shares are not supported by collateral properties of a firm. And whenever we say long-term finance of debt, usually the word debt refers to debentures or taking a loan from bank or financial institution. Okay, this taking a loan from a financial institution, that can increase the amount of the cost because you need to pay a regular amount of interest to bank. However, paying of regular amount of interest is not that case in the cases with equity. Whenever we say equity, it usually refers to equity shares. In the cases with equity shares, it is not necessary for the bank for the particular company to pay a regular amount of interest regularly. Okay, they will pay or they will repay the amount of equities whatever they have borrowed only if the company makes profit. If the company does not make profit, the company is under no obligation to repay the amount of equities. Okay, but that will not be the same in the cases with debt. whatever amount of debt they have taken, whatever the amount of loan from a financial institution they have taken, it is necessary as per law to repay back the amount of loans or amount of debt after every single period of time. Okay. So if a firm wants to have long-term funds, it must analyze well in advance whether they should go for equity or whether they should go for debt. I hope this is clear to you. Next, you see all items of profit and loss account. Now you see whatever items you are going to include in the debit side of profit and loss account or in the credit side of the profit and loss account, you need to analyze beforehand. Here one example is given here you see an increase in the amount of depreciation on our assets or excess dividend to our shareholders increases our expenses. Now no doubt if you include more and more amount of depreciation in your assets, in your fixed assets, take for example in the cars do you have, if you or any trucks that a particular company has, if they include more and more amount of depreciation in those assets, that will however decrease the amount of their net profit, but that will be somewhat good for the firm, because after the expiry of the useful life of that asset, they will have a sufficient amount of funds to replace that amount of assets. Okay, so in the cases with depreciation, that will one side it will be good for the firm, but on the other side that they will increase their amount of net profit. Okay, or next you see or excess amount of dividend to the shareholders. If you pay more and more amount of profits of your residual profits or your leftover profits to your shareholders, no doubt the shareholders will be satisfied, but that will decrease the amount of money that you send to your general reserve. Okay, so all those things is to manage all those activities, to decide all those activities, we require financial management, right? So I hope this is clear to you regarding the various roles and activities of financial management. So in the next class we will be discussing about the objectives of financial management. So please stay tuned with Prudential Business. Thank you so much.